All right, let's talk about a word you hear thrown around constantly, risk. But what if the way we've all been taught to think about it is just flat out wrong? Today, we're going to dig into a totally different perspective, one that could really change the way you make big decisions.
So let me ask you this. What's the single biggest risk when you put your money to work? Your mind probably jumps to a market crash or prices going wild. But what if that's not the real danger? What if that's just noise, and the real threat is something quieter and a whole lot more permanent?
I mean, for decades, if you took a finance class, the textbooks drilled one thing into your head. Risk equals volatility. It's all about how much a price bounces around. The more it jumps, the riskier it is. Simple enough, right?
Well, hold on a second. According to Howard Marks, a true legend in the investing world, that academic view isn't just a little off, it's dangerously misleading. He argues that focusing only on those price swings can actually trick you into making terrible decisions, all while you're blind to the dangers that can really wipe you out.
Okay, so let's get into Act 1, understanding risk. We've got to start by redefining the real enemy. If it isn't just bouncy prices, then what are we actually supposed to be worried about?
And here's the core idea from Marx. Real risk, the kind that should keep you up at night, isn't about the price dropping for a week or a month. It's the very real chance that your money is gone for good. It's the permanent loss of your capital.
And just to be clear, this is not the day-to-day market drama. It's not a scary headline. It's not a quarterly report that misses expectations. That's just the market being the market. True risk, the permanent kind, is when the underlying asset, the business itself, is fundamentally broken.
And when you hear Marx put it like that, it just clicks, doesn't it? It forces you to completely shift your focus. You stop obsessing over those squiggly lines on the screen, and you start asking much better questions, like, is this a solid business? Is its value going to be here in 10, 20 years?
So you've got these two camps. The common view says that taking on more risk automatically gets you higher returns. It's like a guarantee. But the Marx view is way more realistic. It says, no, higher risk doesn't guarantee you anything. It just gives you the prospect of higher returns, alongside the prospect of losing everything. It's a possibility, not a promise.
Okay, so that leads us right into Act 2, recognizing danger. If the real risk is this idea of permanent loss, where does it actually come from, and how in the world do you spot it before it's too late?
And this is where it gets really fascinating. Here's the great paradox. The biggest risks don't show up when everyone's scared and panicking. No, risk quietly builds and builds when everyone feels amazing, when they feel totally safe and believe that nothing could possibly go wrong.
So how do you do it? How do you spot that danger when everybody else is high-fiving and celebrating? Well, you have to train yourself to be a bit of a contrarian, to look for the little clues that things are getting reckless even while prices are going through the roof.
These are the red flags you're looking for. You see extreme optimism everywhere. You hear those 4 dangerous words. This time, it's different. You see people paying crazy prices for things and borrowing tons of money to do it. Basically, caution gets thrown right out the window. When you see that happening, alarm bells should be screaming in your head.
Which brings us to the big payoff. Act 3, controlling your fate. We know what risk is, we know what it looks like. So now, how do we actually build our defense against it? First off, there's a huge difference between risk avoidance and risk control. Avoiding risk means stuffing your money under a mattress. Sure, it's safe, but it's never going to grow. Risk control, on the other hand, is about intelligently taking risks where the potential reward is big enough to make it worth your while. That's the game we want to play.
So how do the best investors do it? It comes down to a really disciplined playbook. You see the steps here: demand a margin of safety, don't overpay, be defensive, and never ever make a bet that could take you out of the game. But pay attention to that first one. That's the foundation for everything.
Margin of safety. This is the most powerful tool you have. Think of it as your personal shock absorber. All it means is buying something for a price that is significantly less than what you think it's actually worth. That discount, that buffer, is what protects you if you're wrong, if bad luck strikes, or if the world just plain changes. It's your cushion.
And this quote just nails it, doesn't it? It reminds us that long-term success isn't about being the most aggressive person in the room. It's about surviving. It's about making sure you're still standing after the storms pass. You know, good defense is what wins championships, and it's what wins in investing, too. So let's pull all this together. How do you take this and turn it into a new mental model that you can actually use? Well, it all comes down to 3 key pillars.
First, understand that real risk is the permanent loss of your money, not just market jitters. Second,
Recognize that the moment of maximum danger is when everyone feels safest. And third, control that risk by always demanding a margin of safety. Understand, recognize, and control. That's the framework.
And so we'll leave you with a question to chew on. Using this new lens, look at the world around you right now. Where do you see a total absence of fear? Where has caution been completely thrown to the wind? Because if Howard Marks is right, that's exactly where the next big risk is hiding in plain sight.